Hey, this is BA and welcome to WD Gann and Lost Motion. Let's get started. WD Gann would miss on his price calls by a few cents. Translated into currencies, this would be a few pips. He called this slippage or lost motion. I received this email today from a trader friend into one of my private email accounts, okay? And that's what I decided to do this video on lost motion because I think it's important. He states, my first AOR forecast was just 16 pips away. AOR stands for angle of repetition, if you don't know. Forecast low May 4th at 0.7463 and low was May 4th at 0.7447. Now this is in the currency pair called the Australian dollar, US dollar. Or Aussie dollar is what I call it. The forecast difference was 0.02%, which is a trivial amount compared with 3.5% fall on that turn. Not bad, not bad. But is this normal to miss? I mean, he's definitely happy about this, but is this normal to miss? Well, let's go and take a look. It is normal to miss by a few cents from the exact price call, and I will show you my own trading strategy to deal with this in this video so that it is not a problem when you are working with the angle of repetition. Rule: each stock, commodity, index, or currency has its own average lost motion. Simply taking about 6 months worth of turns and writing down the lost motion for each turn, then averaging them together, you will be able to see the average lost motion. That's how it's done. Okay. In IBM, the average lost motion is about 0.25 cents, which is a quarter of a dollar, with the extreme being about 40 cents. So the extreme lost motion is about 40 cents in IBM. And in my opinion, this is sloppy. It is sloppy. Currencies have a much smaller average lost motion and a much smaller extreme lost motion. Each instrument needs to be tested for lost motion on an individual basis. Never assume, always test out to acquire the average lost motion. Okay, very important point. Never assume, always test out to acquire the average lost motion. Let's go take a look at IBM. You know, I always feel a little weird doing those slideshows. I can't wait to get to the chart because I feel at home with the chart. Okay, on February 11 of 2016, IBM made a low at 116.90. And yes, I'm an IBM options trader, and no, I couldn't trade this. I was in a no trade zone. So I missed this entire area, which I mean, this was a dynamite move down and an even better one going up. I mean, it went rocketing up. So I missed this area, but we're going to examine it, and especially down here. First, in my other videos, and in this one, no exception, and in my price recaps, market recaps, I showed this line. Okay, as you can see, price walked down this line. Very important, this line, and someday I hope to get my video done on it because I want to explain actually what it is to you, which is very important. Okay, let's go up here and zoom into this area. And now the angle of repetition on this one, the angle of repetition is 270 degrees to the moon, which would have given a price at 117.04, which is right here. So this was the exact point that would have been forecasted. Okay. Now, to take in the extreme lost motion, we need to add 40 cents to that, which would make 117.44. And we'll mark that off. 117.4 right there. Come on, open up. There you go. I'll make this red. Hopefully the contrast can be seen in the video. Okay. Now, as you're coming down, you're in, and you cross that red line, you're in what I call the turning zone. Okay. Because this is extreme lost motion. If you were coming up, the extreme lost motion would be 40 cents down from this projected point. But since we're going down, so once that red line is crossed, okay, there's, in my own trading, what I personally do is one of two things. Either one, I'll just get out of the trade there. Sometimes it'll be like I'm leaving on vacation or something, or I'm busy and I just want to exit. I don't want to play with it. So I'll exit at that red line sometimes. At other occasions, when I'm feeling frisky, for the lack of a better word, I will throw on a trailing stop as soon as it hits that red line. And as it goes down, I tighten up that trailing stop, making it smaller and smaller and smaller until it arrests it, and that will get a little bit of this move. In here, between the blue and red lines, or the top and bottom lines, is about 50 cents. I'm sorry, it's about 40 cents. But between the red line and the low here is about 50 cents. A lot of people don't like leaving that on the table, but this is like a 7 or 8 point down move. Even if you got in here at the low, which would have been right here, if you would have got in here, and if you would have got out right at the red line, I mean, you would have made close to $8 in about a week, which is not bad on IBM, especially if you trade options. That would have been a good trade. Would have been even better going up, but that's enough of that. So anyway, I use this red line, which is what I call maximum lost motion or extreme lost motion. I use that. I'm either out there or I'll throw on a trailing stop and fiddle with this and try and squeeze a few more cents out of it. It just depends. Okay. But either way, it would have been good. It's all good. It's all good. Hey, let's finish up this video. So it's normal to have lost motion, and not only in the angle repetition, but also in Gann's price system known as Gann squares. You know what Gann squares are. Okay, that system also has a little bit of slippage or lost motion. In fact, all of Gann's price systems do. Okay. If you've gained insight from my videos, subscribe so you can get the latest on my free market calls, updates, commentary, and teachings. In the book, The Tunnel Through the Air, Robert named the Saint Marie on page 225. What significance does that have? What significance does that have? If you're stuck on this one, I can tell you that it is indeed important. It is very important, and that you need to study your planetary time periods. Your planetary periods. Knowledge is indeed priceless. Hey, this is BA reminding you, you can succeed. Take care. Bye-bye.